All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. This morning, I got a note saying, "Hey Jeff, it looks like the market's turning bullish. Things are coming back to life for the bulls, and things look to be really changing here." And my response back was, "Why do you say that?" And the response back was, "Well, the indexes are up." And I responded back. I said, "I'll talk about it on video here, but bottom line is." If we're talking about bear market conditions, indexes up don't matter. Yes, I know. Yes, it matters in terms of the price is different, but index up doesn't mean bull market gone or bull market is here. Index is up doesn't mean bear market is done. In fact, when we talk about bearish market conditions, having big upticks is one of the characteristics of a bearish market condition. When we're talking about big raging bull markets, having 20-point rallies in a matter of 30 minutes, that rarely happens. That almost never happens, right? One of the big signs that we're in more bear market conditions is we see sharper, faster, swifter rallies. When in a bull market do we see the small cap ETF, the IWM? When in a bull market do we see the IWM rally $1.60 in a matter of 20 minutes? It'll have days where it's up $1.60, gaps up 80 cents, and drifts about 80 cents higher the rest of the day. It'll have that type of stuff, but it doesn't have these kind of sharp rallies, sharp, fast, quick rallies like what we are seeing in the market now. And so index is up does not mean bull market, conditions. What would it take for a bull market to emerge or for a resumption of a bull market to emerge? Well, it would take a couple things. Number one, we need to see the average true range on the market start to fall, right? And if we come in here and we come into stock charts and I just put on, maybe, let's see if stock charts is going to have the same issues as it did yesterday. Looks like it's trying to. Here we go. But when we talk about the average true range on the market, you'll notice it's been expanding. Generally, in bull markets, you start to see the average true range fall. But more than that, the market at least needs to close above the 7-day moving average, right? I mean, we don't have a bull market ever happen without that. We don't have a big, bad, bullish run without that. And that's one of the first things that, the market would have to do or we'd need to see from the market. Yes, this morning I know the market pushed above the 7-day moving average for a little bit, but, closing above that level is the first thing that needs to happen. Also, when we're talking about pullbacks, how many pullbacks are 3-4 days? Not a lot of them. Most pullbacks are 2 to 3 weeks, not 2 to 3 days. And, occasionally we do get a pullback that's a matter of days. We had it right back here at the beginning of March. And I know that pullback is fresh on a lot of people's minds. And so they're discounting what's happening now because of what happened at the beginning of March. That's very natural market mentality, market thinking, your trader thinking. And it's only human. But at the same time, one tendency breaker doesn't define a new tendency. And so, it's just one of those where what's it going to take for the market to go back into a bull market? Well, we need to see, one, a break back above the 7-day moving average. Two, we would need to see the average true range on the market start to fall backwards. And then three, we just need to see the metrics start to turn. I mean, we've talked about some of these big, bad, bearish metrics, and one of the biggest is just the IWM and its performance relative to the S&P. And, if I come in and put that performance chart back up here, and I'll show you the settings on it as well because I was asked about that the other day. But you can see the settings here for comparing the IWM to the SPY over a 30-day period. These are the settings. Type as a performance chart. And I just have 1 month, and then indicator is price performance, and I put the SPY there, and then the IWM up here. You can do it the opposite way; you get the same data. But the IWM is 3.3% down over the last 30 days. The SPY is 0.7 up. I mean, there's a 4% differential here between large caps and small caps. That's a huge differential. That is square in bear market territory. We have a day where small caps are up 2%, large caps are up 0.5%. Okay, you know what? We could be talking about some major change at that point. For now, for the bulls, this is about a bounce, right? This is about bounces and snapbacks, and there's going to be a lot of those. And sometimes it's almost easier to trade bullishly in a bear market type environment because the snapbacks are quicker, the rallies are sharper, and so it can make it a lot nicer there. But you do want to be a little quicker on the trigger in terms of profit taking if you're going to play that type of style here with it. Let's see if I can bring it up here. Here's the market vibe. And we saw it turn bearish on Friday last week, and it's still turning bearish. But I'll show you just the performance here. The market vibe's been going since 2015. This is an automated algorithm. This is not, Jeff's interpretation or somebody else's interpretation. This isn't, any human element that comes into calculating this. And you can see that since September of 2015, there have been 420 trading days where the indicator has been bullish. The average gain on those days is 0.16%. It's not a whole lot, right? It's not a whole lot. But the total daily gain, 67%. It's been neutral a lot over the last several years, 311 days. What's the average gain when the market vibe is neutral? It's 0.02%. Doesn't move. I mean, the aggregate gain loss over the course of 300 neutral days is 6%. Pretty darn neutral. Bearish, we've only had 133 days. Total gains 30% negative. Market's gone down 30% as the market has had a bearish market vibe. The average daily gain is minus 0.3% or minus 0.23%. Much bigger average loss than an average gain on a bull market. We can see this shaping up for 2018 and how that's shaped up. We can see how it's shaped up so far for 2019, and it's the same type of data, right? The same type of metrics. Yes, there were 4 bearish days so far this year. Before the last the last few that kicked in, which are not calculated on the last week is not included in this, but you can see that even with some of the whipsaw, the elements have played on out. And so when I look and I see a bearish market vibe, I'm not looking and saying, well, you know what, it just means the market has to go down and down forever and everything else. No, but the tendency is that the biggest down days happen when the market vibe is bearish, and that's what we are seeing right now. But we also have to keep in mind that some of the biggest up days in the market also happen when the market vibe is bearish. And that's not reflected in this data, but that is a reality of the situation. You can see that over the years, I mean, since 2015, we haven't had a lot of bearish days. 31 in 2015, 48 in 2016, 46 in 2018, only 4 in the entirety of 2017. That's insane. That's absolutely insane. We've had 8 now already this year, and the market's had a much better year than 2017. overall, at least at this beginning rate. But we've already had more bearish days. But overall, you can see what this looks like, and so when we see the market metrics, we see the internals, it just tells us what that tendency is. And so, for a bull market condition to break, we need to see the internals, kind of come back. And one of the big ones is this large cap, small cap performance. We've talked about things like the bullish percent index, which has still been kind of controlled by the bulls, and we see it ticking on up. This is not given a bearish indication here just yet. So it's not, bears control or bulls controlling everything, or bears controlling everything, but, we need to see the bulls kind of make some comebacks with, some of these metrics, including volume and, number of stocks trading above moving averages. One of the first signs that we see that the market vibe is switching, or the market dynamic is switching from bearish to bullish, and we see it almost every single time, is that the number of stocks trading above the 7-day moving average tends to go from about 100 or less than 100 to above 400 in a matter of a 1 to 2 day period. Right now, it's only 225, so only 45%, 44.5% or whatever, are trading above the 7-day moving average. Today, we don't have a major spike in number of stocks, pushing above the 7, the way we typically do when the market shifts, and so, the conditions, the environment, it is about the same as what it's been, here this morning. Now, overnight, we had an interesting test or another push down in S&P futures, where futures fell here overnight, came down to 27.95. And we can see this kind of 2790, 2795, under 2800 has been kind of a significant support level. Yeah, I know it's broken it a little bit, but overall it's been a very significant support level here, for the market. And we see this type of level shaping up even with, small caps, the IWM, but on a higher type of higher lows, right? So, it's an important level. It's a key level, and it's one that, if it were to break, would it create some further selling? Yes, but it would not change market conditions. It wouldn't change to go, well, now the market's more bearish than, the metrics are now more bearish than what they were, or something, of that type of, that type of rationale there. Okay. But, where the market sits, it's a pretty flat day. Pretty darn flat day here today. The big loser in the market today is who? It's utilities. It's utilities. As we see money squeezing out of those after, what has been a big rally in utilities, sparked by this just massive breakout in bonds, pushing on higher here. And so, we see utilities kind of leading the way with the selling. Outside of that, we see generally, a little bit of strength. Banks are giving up some of their strength. You can see the XLF still hasn't managed to get above that 7-day moving average. I find it, we saw a stock like FedEx this morning get downgraded. And the stock gapped down and got bought up right away and is still in the green. And, if we're seeing stocks get downgraded and trade in the green, that's not a comfy feeling for cozy feeling for the bears, to see downgrades go green in the same way as, for the bulls seeing upgrades go red, never feels all that great. But we do see that here a little bit this morning. So, yes, the market vibe signal is bearish, but, we don't see all out bearish control of everything out there in the market. The market vibe is bearish simply because of the pace at which the bulls have pretty much given up some of the controls. It doesn't mean the bears have taken all those controls, that's an important distinction, especially as we go forward. Now, gold. We've talked about gold a little bit over the last several weeks. And what was it? 3 weeks ago, made a comment or talked about the long-term nature of gold. As gold was kind of making this little bounce right here. And, we talked about the consolidation within the miner industry, the gold miner industry. We broke out some of the weekly and monthly charts on gold and, talked about the just incredible bullish nature. And I made the comment that anywhere in this area, I think, is a pretty decent buy point for long-term gold traders, right? And long-term gold investors. I think it'll pay off very, very nicely. But in the short term, we had the Bollinger Bands contracting. They're contracting. And, what happens when we're talking about a Bollinger contracting environment? Consolidation is a heavy risk. And so in the short term, we even talked about it, right here that, you know what, it may go higher, feels like chasing, looks like chasing. There have been plenty of times where chasers in gold have been paid off. But it's, it definitely is a chaser. We talked about it with gold, GOLD, the ticker symbol, or Barrick Gold, now the company. Let me pull it up. This action here, where breakout action, chasing on higher. Do you chase it? Do you chase it? Do you buy it? Overbought, or do you wait for a little pullback? And I made a comment for me, short term, I want a little pullback. Today we're getting a nice little pullback. We're definitely getting a nice little pullback. Personally, I went and started a GLD position, here this morning. Now, the long-term position, I only put 20% of what I want into it in, right? So just a starter position here for GLD, and one where I kind of hope GLD falls a little bit more to be able to add the rest. But using this sharp drop to buy in. If you've never been involved in gold or traded gold, you will kind of look at this drop and go, ooh, ouch, what happened? Well, things like this are very commonplace when it comes to gold. Just take a look back in here. You don't have to look at the charts all that closely to see massive drops that come into the commodity, and very choppy type drops. I mean, here we go, drop up. We're gonna break on. Chop up. Okay, it's gonna break on high. Ooh, big gap down. Oh man. Okay, here we go. Gonna break on down. Oh nope, we're gapping on up. It can in the short run. I made the comment that hey, these can be maddening trades when it comes to trading short-term gold because of how choppy it can be. But when we start to back out into the mid and the long-term charts, becomes significantly more trend developing, and you can see what gold has been over the last few months or last few years. And, I still would make the argument that it is poised for a breakout, given some of the macro factors that have been going on. And most importantly, and the one I expect to outperform is GDX. This gold miner ETF, and I'm not talking about getting up to 60, but moving into the 30, even 40 level, I think is very realistic for the GDX going forward. We talked about AUI yesterday and the 260 level. Does that come into play? And if it does, that starts to become a very interesting buy point. And that's what we see coming into play here today. There is still more potential downside when it comes to gold. Whenever you trade a commodity or play a commodity, you cannot underestimate the swiftness of a move, right? They can be very swift, very hard, and they oftentimes overshoot. And so it's one of those where, starting positions, getting into a little bit, letting it play out a little, then adding a little bit more, tends to be a much easier strategy when it comes down to it. And today, I used this opportunity. I'm not in the gold miners yet, but I used the opportunity, to put on a little bit of long-term GLD. And by long-term, when I speak long-term, I'm talking 9, 12, 18 months, in terms of, looking at that, at that long term. And you can play that with shares, you can play it with leveraged ETFs, you can play it with, you can play it with the options. In the, for me, it was in the money options, deep in the money options, with the GLD. So that's how I will choose to play it as we go on forward here. Okay, so anyway, that's some of the stuff going on out there. Again, I think most stocks are in more bearish to consolidation modes. And we start to see some of the lows from yesterday give up on things like FedEx or CAT. I think they're very tradable to the downside. I know they haven't broken down yet, but the action they continue to show is this just kind of evolution of a breakdown, and we are seeing that in so many areas out there. The same candidates I've been talking about. One exception that I thought, here this morning as I went through, I thought, Halliburton, this is up about 55 cents this morning, trying to break 29, breaking above the 7-day moving average. All right, does this thing have some momentum here to the upside? And, so far giving on up and still sets up the same way. Breaks yesterday's low. And, that's a really good entry point for a potential downside if you're looking for it. But still, not there just yet, here on the day today. Okay. So anyway, those are some of the things that that I'm looking at, that I'm playing with. I made the comment this morning. I'm not going anywhere on my Home Depot or EEM. I'm not looking at those and going, oh man, what's this hour mean and that hour mean and all of that. These are things I expect to play out over time. Home Depot is more of a, hey, if the market breaks down sharply, Home Depot could do pretty well, but it would need a pretty sharp breakdown. It's been kind of funny. It's been stuck on 190 for days now. It shoots about $2 above it and then drops, shoots a buck or two below it and then pops. My thoughts on it are the same that they've been. I don't think it means a hill of beans, but starts to break below 188. There's going to be some momentum to the downside if that occurs. And then with the EEM, it's up a little bit here today, but same chart. Same chart as it's been since I got in, and there's nothing in the chart today that I look at and go, well, this means that or that means this. It's the exact same chart, and there's still gap risk associated and chop associated, but this is something that I'm still looking for. This 200-day moving average at least to come into play, but I do think there's significantly more breakdown potential, down into the 40 area here for the EEM. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.